Hello, friends. Welcome to Nimble Bang. I'm Piyush Jain, and today we are going to be talking about the markets. The second quarter earnings largely are over. I would say that we are towards the fag end of the second quarter earnings. Almost the first half is now before us, and we are looking at the second half. I would say the third quarter has already started, and now perhaps expectations are that what sort of sectors what actually they would be actually performing, what sort of um, uh, conclusions we should be drawing from the current macro environment, and also perhaps from the perspective of what is happening in the global markets, how the sort of fund flows are looking for the domestic markets, and in nutshell, perhaps everybody wants to know how they should be strategizing, and who better than actually really to answer all of these questions than our guest today. Mr. Yogesh Patil, the CIO of LIC Mutual Fund. Yogesh ji, welcome to the show.
Yeah. Uh, Thank you very much for hosting me on your channel. And there are a lot of bunch of questions basically. It covers everything. It seems to be four, five questions, but actually you covered everything, almost everything.
No, so I'll start with the first one. And the first one, I'd like to simplify. Like second quarter earnings are still ongoing, but largely before us. What is your own feeling? How's the earnings looking to you? The underlying both the revenue growth, the earnings growth, the quality of earnings growth. Is it well spread out? How is it looking to you?
See, slightly the majority of the results slightly below expectations, right? Either they are going missed on sales or basically in margins, basically. But if you ask me, the disappointment still is not very large actually, because the change in the festive season. Because last year Diwali was in October, and so majority of the restocking happened in September and August. This time, because of the difference in season, the consumer goods companies has some different. We need to still the season is on for consumer goods and
Yes, yes.
automobiles. And coming back to IT and BFSI, so I think IT and BFSI is almost equal to our expectations, not very different, maybe minor glitch here or there. Because IT company, especially in majority of the top IT companies, we seen a large deal wins, but execution is lacking today, right? And we need to see two more quarters, and all BFSI numbers are come largely in line basically. So because the season is shifted 1 month from, let's take October to November, even BFSI is not comparable, because still
Great
auto
growth.
finance, vehicle
Yes.
finance, and consumer finance is still. So we
Mhm.
need to do average of 2 quarters. But as of now, we've seen a good traction, basically capital goods and especially investment in power, because energy, green or thermal, both seeing some traction, and the ecosystem around that those sector is also showing some traction. Maybe one or two company here or there, but good order inflows and inquiry levels are very encouraging. And but subdued earning for, let's take a chemical sector. But again, we can't take a blind call on chemical, because again we need to dissect between specialty chemical and commodity chemical. So specialty chemical showing some traction, but still we need to see more traction here. Sorry, more basically visibility from client side. As of now, their clients are still buying, and but what the impact we see in some of the chemical specialties, basically dealer destocking. So
Okay.
end consumer is consuming, but just dealer is not buying because of higher interest rates went up. So he might be thinking, or maybe try to optimize his ROI. Basically, that's what we guess from managements, because their interest rates went up from, let's take a point 0.5 2 years back to, let's take 5%. So cost of holding inventory is high, and that up to some extent led to a destocking, and that we've seen in last 2 quarters. Maybe it will
Mm.
continue 1 or 2 quarters, but end consumer is still there. So these are the broader views on the sectors.
Right. On the BFSI, such an important sector, like even an index constitutes more than one third of the weightage. But broadly, BFSI, if I actually keep the festivity part apart, apart from that, what's your own sense? Does it appear that even after the series of interest rate hikes, the BFSI, the banks, the NBFCs, they have been able to manage their credit growth really well?
Yeah, yeah. I don't love if you love, you see the commentary of most of the large banks and NBFCs. They see a strong demand. In fact,
Yeah.
I can't name the company, but some of the NBFCs actually increase the H2 outlook. It is very
Mm.
surprising to us. One side we are saying looking for slowdown, reasons for looking slowdown, and one side some NBFCs are showing good, increasing
Even
guidance. Basically.
even Yogesh, the fortnightly credit growth numbers which keep coming regularly, those have not even once actually showed any signs of slowdown. Like continuously, they are painting strong numbers.
You're right, actually. But again, we need to re-evaluate this data on till at the end of Q3, basically, because we don't
Hmm.
know. Uh, because in so many cases, a large part of the credit is driven by working capital, maybe
Yes.
personal loans and your home loans. So these data get bunched up and reshuffling of loans. But as of now, it looks 14 to 15% credit growth is quite doable. And within that sector, the market share gain loss may be a company specific, depend on their borrowing cost, depend on their service levels, basically. So
Right.
India is still growing at a healthy pace. Maybe may not be, let's take a 6 plus, but if you remember 15 20 days back, IMF also increased the India GDP outlook from 6.1 to 6.3. So if you adjust inflation, India is somewhere growing around 10 to 11% nominal GDP. And if you see the historically, 1.3, 1.2 sort of multiplier on nominal GDP, then we are almost there, 13 to between the range of 13 to 15%.
Right. So, in such a situation, like I wanted to ask you more on the sectors, but then listening to your answers, one question actually came to my mind, and that was as a CIO, when consistently you're getting a lot of inflows every month, SIPs or different forms of sort of inflows. When you look at this data, the second quarter earning numbers, and then also the different types of data, what's the bias right now? What's the stance to really sort of invest as much as possible, or to basically right now sit on cash? Like this question is also related to valuations also, but how's the stance?
See, again, investment is case to case. See, there we also keep some cash in funds. You're right, actually, up to some extent, we increase our cash level, but not a very big way. Maybe we increase our cash level 2 3% extra what we used to keep the cash. But is not exactly because we want to. We are not positive on market. Maybe scenario uncertain. As a fund manager or maybe as an investment team, we always see case to case business, because there are some businesses which continue to do well in this scenario also, and we need to figure out those businesses. Point number one, and point number two, there are business which had impacted due to global crisis, or maybe recently Israel Israel Hamas issues, or Russia Ukraine valuations. So not exactly like to like basis, but definitely there are good companies, good businesses. They are showing good traction. And when anyone is investing for, let's take a more than 3 to 4 years, so he should not worry, because waiting for market to come down and then invest, it is not a right strategy. Maybe we can avoid some event risk for some time beyond a point, but good businesses at good price, definitely everyone should buy, actually, because last 20 30 years you take any crisis, and if market, I don't have any timing when market will turn, but but market will come down, market will move up quickly. If you see the history, within the 40-50 days, there is a sharp up move also. So investors should not
Mhm.
worry if they are looking for 3 year plus investment horizon.
Absolutely, words of wisdom. So all these opportunities actually they come only at a very strong level when the markets actually they see a dip. So those are the words of wisdom coming from Yogesh. Yogesh, let's also talk about the FI24. Overall FI24. What are your expectations? And behind this question, the premise is on one side you have the global markets. Second side, you still have doubts whether the global central banks are going to increase more interest rates, how the RBI is going to react. And then on the third side is a strong sort of all those macro numbers. So how is FY24 looking to you?
FY24, there will be a roughly double-digit growth on in terms of if we see the Nifty EPS also, largely driven by BFSI segment. And in terms of see, market is pricing everything today, right? Is almost very similar to October 21. Its market was somewhere around 19,000, and still there is 19,000. So only if you see that time the valuation was roughly 28 times 1 year forward, and today is roughly 18.5 times 1 year forward. So valuation has crashed. The level is still there, right? And at the same time, uh, is gives some opportunity at regarding the interest rate. Yes, interest costs are moved up, and maybe a 25-50 beeps from here. But one thing as an investor, we need to always be questioning ourselves, because see, these are the eras, right? Last 15-20 years, we seen a lose money policies, and everyone was looking for inflation growth, right? And incrementally the interest rate will continue to be high because of the high fiscal deficit. It doesn't mean investors should not invest, because in last 15-20 years we've seen returns largely coming from valuation or re-rating. But there
Hmm.
are fair chances because high interest rates provide basically are the entry barriers for some of the big corporates. So their competition would be very limited. So existing companies can be more valuable, and incremental stock returns can be seen via earning growth, not on valuation relating. So we
Hmm.
need to spin these two things completely differently, because what drives the stock prices basically valuations, liquidities, and your earning growth. If earning growth is there, valuation is already captured in the high interest rates, and liquidity somehow reduced. If you see the FI selling in debt and equity, I think last 2 year, if you see the not very encouraging number. So everything is in front of us, and earning growth is, I think, if you use the Nifty earning from 2013 to 19, Nifty earning was flat, but still next 2 year we see double digit earning.
So, sir, in this case, which sectors you are picking up as a standout winner?
I can't exactly tell you sectors, but I'll give you trends basically. The first trend is basically Atmanirbhar, where government is actually focusing on domestic manufacturing. That includes defense is a new trend, and that includes your some of the chemical pharma companies. So these are the new trends. Second is basically China plus one and PLI, because majority global vendors they want to shift their vendor base completely or partially from China. So that give you traction in basically auto ancillaries, casting, forging companies, capital good companies, electronics, manufacturing as of now. But now, as of now, some of the companies doing only assemblies, up to some extent in chemical and specialty chemical. And there is a good demand in basically investment in energy, renewable versus and both in renewable power transmission and thermal. And government also basically focusing on developing an infrastructure, because if they are inviting other MNCs to set up a shop here, like Apple and other companies, and some of the MNCs already have a base in India. So India has to develop infrastructure first. So, one is infrastructure is also a very promising sector, and the remaining then again job creation and discretionary consumption will take off by maybe next year once the employment generation start happening. So these are the 4 5 growth drivers for India, which will play out in long term for next 10 years. But these are the irreversible trends, and any stock sector is come under this kind of basically trend, which is the basically strong buy, because majority of the MNC companies are taking the benefit of basically capex of, let's take a 15% tax incentives. So some of majority of those companies already done a 2x capex. They increase their capacity by 100%, 50% based on their outlook. So it also showing a traction from multinational companies, domestic companies to cater a global demand, and China plus one. So these are the positive signs for India, and some of these opportunities you will get only once in your lifetime. We seen this kind of opportunity in 91, then 2003, and this time after COVID. Basically, it for next 15, then these trends will drive India growth story for at least for next 10 to 12 years.
So and we actually indeed have seen many of the companies actually coming and then getting listed from the manufacturing space, as you just highlighted, defense, chemicals, and a lot of new manufacturing companies getting listed on the bourses. Um, from this perspective, uh, would you actually then see that perhaps manufacturing is one sector where you will keep finding sort of new stories and new sort of long term growth levers? Is that something which is a really focus sector?
Yeah, yeah, definitely. If you see the gross fiscal capital formation was a roughly 37% of GDP in 2012. I'm not going 2003 to 8. And in that particular time, the real estate was the major driver, right? And today
Yes,
is
true.
somewhere around 27, where real estate has not picked up. So if you remove this, India still has a lot of potential. And in after I think after 14 or 15 years, we see the corporate world is investing money. Like we see a strong capex in chemical specialty chemicals, cap good company, engineering companies, casting companies. So these are the major driver for capex, and it shows their confidence, and their confidence coming from basically clients interaction and increasing their addressable market. So definitely manufacturing will pick up from here, and government has done all kind of arrangements and reforms what need to be done.
From this perspective, sir, one thing also wanted to ask you is that now LIC basically sits on a large corpus of money. We have two triggers. One is the long term, which you're just talking about. That's like the India story, like so many opportunities will keep coming up. And then another one is really where I want to actually take your view is actually sort of story perhaps for the next 12 months or maybe 24 months of sort of gains in the debt funds. How do you see now the opportunity debt market, given perhaps we are near or at the peak of the interest rate cycle? How do you see that part of the market?
Yeah, definitely, you're right. Actually, now the maybe after 2 quarters, definitely interest rate RBI might rethink their strategy and start cutting rates, and debt fund will be biggest beneficiary. Actually. So I can't discuss basically fund specific, but you are right. Actually, there is a equal opportunity in debt and equity both, where investors can make money, and the only difference is in debt fund. Basically, the opportunity or maybe is only for 12 months, next 12 months, or maybe 1.5 year. For equity, is it for next 10 years? That's the opportunity size and upside. You know the equity when we seen in 2003 to 2008 cycle, where some of the basically small cap become a mid cap, and mid cap become a large cap, and then become ultra large cap. And we've seen this trend will continue in much bigger way actually this time, because between 2003 to 2008, China was competing with India, and Korea, Philippines was competing. But today there is no nearest competitor for India. Actually. That's one of the reason India is a preferred economy today, and not government also done a lot of work. Corporate world is also open to listen, and global forces driving this China plus one. So from everywhere, India looks good, and I hope this momentum will be much bigger, and not able to actually calculate very easily, because if you see the global share of Indian export is still minuscule, maybe in some cases in less than 1%, where China is maybe 40 times or 20 times bigger in some sectors, maybe in some sectors 15, 10x bigger. So India may not able to overtake China, but definitely India can actually improve their past track record, and the sector growth be very easy. That's for sure.
And if I think we move towards our last one or two questions, and that would be if we talked about the results, we talked about the FY24, we talked about different sectors, opportunities. And if I actually want to sort of almost end on a note about the index, if we are talking about a sort of a nominal growth of around 13, 14, 15%, um, would you say that the current valuations they are sustainable for the index? Where are we right now? Because there's a lot of debate, which every time it happens, and I think it's going to remain like this. But where are we right now on your own valuation comfort, broadly on the index? Because index sometimes is used as a benchmarking for mutual funds.
Yeah, definitely. See, I said nominal GDP is somewhere around 10 to 11%, not 13%.
Okay,
I'm just correcting
I
you.
stand corrected.
Yeah, yeah. And the second point, see, if you see the Nifty valuation is around 18.5 to 19 times, is a fairly value. It is not mispricing is not happened maybe on downside or upside. It is a fairly value, and market normally pricing very well everything much ahead of the time, like your election, global events. Maybe from here you can expect basically large cap is due for up move if you see last 2 years. So maybe in next 12 months you might see or index, especially Nifty, will catch up the earning growth, and because there are a lot of big companies listed, unlisted, yet to show their traction. Maybe those traction will be visible in Q4 results, and there will be then EPS upgradation for outlook for 24 and 25 both will happen, and we see a moderate returns from here, in especially large caps. And mid and small cap basically is a sector specific, company specific story, and they are doing well. Some of the small cap, mid caps are actually growing 15% plus, so definitely returns will be higher there. But the mid and small cap also carries some risk and liquidity risk, promoter hierarchy risk, and their ability to grow and raise capital. Definitely, those are the constraint for that segment. That's mid and small cap segment basically. But I wouldn't see any major downs. No, anything which is index is mispricing today. Valuations are fairly valued today.
Right, and perhaps I think that is something which our viewers should really take note of, because always whenever the markets are soft, perhaps this is something which our the retail audience, all the viewers, they really actually worry about. So those are the important conclusions. And as we sort of sum up our entire conversation, my will end with this sort of question. We are now with almost 5 months for the FY24 to end. I'll ask you a simple question: are we ending on FY24 or on a positive note in an election year? Like, what will be your sort of a simple conclusion?
Uh, See, earning growth, normally market follow earning growth, and I don't see any major risk to earning growth. I indirectly
So
answered
we'll
your question.
okay, so we'll take that as the answer. And thanks a lot, Yogishi. And I think we'll look forward to more conversations with you. For now, thanks a lot coming on the show.
Thank you very much.
And dear viewers, I hope you enjoyed it. For now, it's a wrap.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.